Okay, we can start now. It's 3 GMT. We're going to talk about euro dollar ahead of the ECB, the European Central Bank. It's a very important meeting. We'll explain why and what headache is facing the European Central Bank and give some background. Quick introduction about myself. My name is Yohay Elam. I founded ForexCrunch.com. I used to be a retail trader and also a computer programmer. I founded ForexCrunch back in 2008. I focus on fundamental analysis and also talk about technical, but I lean towards fundamental analysis. This is how my website looks like. Here's what we'll cover. The current situation, euro dollar, rundown of Friday's non-farm payroll action, which was quite wild. Some background for the European Central Bank's decision on Thursday. The various options that Mario Draghi, president of the ECB, has on Thursday, and scenarios for how euro dollar could react. And of course, at the end, questions and answers. Let's begin. This is a graph of the euro dollar daily chart I took on the weekend to make the euro dollar weekly forecast. This is the world's most popular pair, two most traded currencies, and it's trading in range for quite some time. Ranges are becoming more and more narrow, and it's becoming a nightmare for many traders. Some of you, I'm sure, like range trading, but it's become slow and sometimes frustrating. What's going on with the euro recently? Basically, the euro is bid. No news is good news. When nothing happens, the euro tends to go up. And when the euro falls and euro dollar falls and some bad news, it's more of an opportunity to buy the dip. You have the dip down, you buy the pair, and you take some profit. There are flows into the eurozone from China and from other places because there was a danger of a euro breakup years ago, and now everything looks okay. So money is flowing in to enjoy the high yields that bonds from Spain, Italy, Portugal, and Greece are offering. Around 2 years after Greece defaulted practically on its debt, it made a bond auction and it had a huge success. So it shows how popular euro bonds are, and the euro is bid, but it isn't so good for the European economies that have a strong currency rate. We'll talk about that soon. Let's go back to Friday. What do we have Friday? On the good, bad, and the ugly. The good news from the United States in the non-farm payrolls report was that the United States gained 288,000 jobs, according to one survey. According to another survey, it didn't look so good, and that the unemployment rate dropped from 6.7 to 6.3%. And more good news, the real unemployment rate, which also comes to discourage people that are too depressed to go look out for a job, also fell from 12.7 to 12.3%. But on the other hand, the drop in the unemployment rate was the result of the drop in the participation rate. So less people are counted as participating in the workforce. It dropped from 63.2 to 62.8. Another worry was that there was no change in earnings. It means salaries stay the same between March and April. No wage growth means no inflation. We'll talk about inflation in the European context very soon. Anyway, it doesn't show that the economy is growing. And also, there are too many temporary jobs and not full-time jobs. So that's the bad news. And the ugly is just the chart. We can see this big dip and then the rise again. As the aforementioned, it was by the dips. In this case, it's the euro dollar chart, but it's a 30-minute chart. But the same happened also in other dollar pairs. So we had this action. At least we had some more volatility than normally. That was Friday, and that complicated the situation. So what we could learn from Friday's non-farm payrolls is the markets are still looking to sell the US dollar. Euro-dollar exchange rate, it remains stubbornly high. And the big question is, will this lead the ECB to action? You see here that the euro is strong also from this nice picture. Okay, European Central Bank, it has a target of 2% or a bit below headline inflation. Not core inflation. It doesn't have a combination of employment and inflation, just headline inflation. Prices should rise around 2% per year or just a bit lower. And the target is being missed month after month. This deteriorated in the fall of 2013. Low inflation means that the debt burden is heavier because you can't inflate away the debt. Europe has quite a lot of debt. And the bigger worry is the D word, deflation. Why is deflation bad? Deflation is when prices fall. It should be good for us as consumers when prices fall and we pay less. But when prices fall, consumers expect them to fall even more and they don't buy. So factories produce less, people lose jobs, and then there's less consumption once again. This is a vicious cycle. It's what happened during the Great Recession, the Depression of the 1930s. It's what happened in Japan after the boom and bust of real estate there in the 1990s. And Japan had since then 2 lost decades. So falling prices aren't always that good. And also Europe tries to avoid that. Also the ECB wants to keep to hit its target, which is 2% or below. What happened since October? The big fall in inflation began in October with a fall to 0.7% from above 1%. The ECB reacted immediately with the rate cut from 0.5% to 0.25. But since then, it continued deteriorating. The lowest figure was in March, just 0.5%. And core inflation, which the ECB began talking about, although it's not its main target, fell and twice 0.7%. That was the bottom. Another thing I'll mention for the next slide is that in April, headline inflation reached 0.7% and core inflation rose to 1%. But this is only the preliminary figures, and they're still very low. What did the ECB do in recent months during this development of very low inflation, or lowflation, as some people call it? Well, first of all, they denied deflation. They did warn that if this lowflation stays for too long, it is dangerous because there is a lower chance of getting out of the situation. And what else? Let's talk about the exchange rate. We're here all about forex. So a strong euro means less attractive exports and cheaper imports. So if someone wants to buy European goods, they're now more expensive. And when Europe imports goods, they become cheaper, and this all pressures prices lower, and is a burden also on the economies that there is an unemployment rate of around 12%, 11.8 in the Eurozone. It's not the main target of the ECB, but of course, lower unemployment means more economic activity, means higher prices. So the euro is too strong against the US dollar each time, and the ECB doesn't like it. So each time the euro dollar moves towards 140, or moves up in general, but especially towards 140, it triggered comments by Mario Draghi and other ECB officials and also European politicians. But it's important to note that euro dollar is not the only thing that Europe looks at. Another huge trade partner is China. And what happened in recent months in China is that after a long period when the Chinese yuan appreciated, strengthened against the US dollar, suddenly China changed course and began weakening its currency to improve the situation in China. So the end result is that with the euro stronger against the dollar and the dollar stronger against the Chinese yuan, the situation when the euro against the Chinese yuan went higher, the levels last seen in 2011, and this also is bad for Europe. So what the ECB tried to do later on, apart from denying deflation, is to talk about the steps it can do to stimulate the economies, and on the way try to weaken the currency. So We talked about technical readiness to set a negative deposit rate. We'll talk about negative deposit rate later on. And the last meeting of the ECB in April, they said they're unanimous about the options to use non-conventional monetary tools, means quantitative easing. Quantitative easing is what is done in the United States, in the UK, and Japan, basically to print money, buying bonds, and thus lowering long-term interest rates, and on the way, adding liquidity or just money into the economy. What we heard lately in mid-April from Draghi is another step forward, explicitly connected monetary policy to the exchange rate. He said that if the exchange rate keeps on rising, it'll probably trigger more monetary stimulus. So what will happen now? See. So basically what the ECB would like best is to have a lower exchange rate of the euro just without having to act. This way, the ECB keeps all its ammunition. One tool that it doesn't have anymore is the interest rate, the main lending rate. The interest rate is already at 0.25. It lowered it from Draghi, inherited an interest rate of 1.5 from Jean-Claude Trichet, and he lowered it 5 times, last time in November. Why is the ECB trying to use words? Because it worked very well with OMT. Back in 2012, there was huge fear of a breakup of the euro. Euro dollar was as low as 120. I don't know if all of you remember that. He said he'll do everything it takes to preserve the euro. A month later, he presented the OMT, outright monetary transactions, which basically is a mechanism that allows the ECB to buy bonds of countries asking for help. He never had to use it. Since then, the situation improved, trust came back, money came back into the Eurozone, buying bonds, and also strengthened the exchange rate of the euro. So now it's coming back to hit Draghi. Anyway, he wants to use words. It's a better tool than using for him than using than acting. But talk is cheap. Sure, some of you know this expression. It isn't working that well. Each time he said something, at the beginning his statement had a stronger impact and later a weaker impact. Especially the second time he said once again that there's a connection between the exchange rate and monetary policy. It had a very, very short impact on the euro. It enabled again traders to buy the dip, buy a relatively lower euro dollar, and to enjoy the profits just 1 hour later or something like that. And so verbal intervention is having a diminishing effect. On Friday, this good-looking, at least, first non-farm payrolls report from the United States had only a very short impact as well, yet another by the dip, and it did not save the Draghi. So it didn't lower the exchange rate. And the exchange rate, last time I looked, was 138.30 or something like that. It remains stubbornly high. So markets seem to be looking for action from Draghi and not only words. Here are the 4 scenarios now that I see for the decision on Thursday. Just mention the ECB announces its policy on Thursday at 12:30 GMT. That's 1:30 in London, and then 45 minutes later, when it's it's 11:45 GMT. And then it makes its press conference. Draghi meets the press at 12:30 GMT, and exactly the time when the US also releases weekly jobless claims. This should be a big event. Hopefully, it'll raise volatility. Here are the 4 scenarios that I see. Another cut of the interest rate, although there's not much to do there. No action at all, just words. Setting a negative deposit rate, and quantitative easing. Of course, there can be a combination of any of these tools, and it's important to know that there are two phases. The first phase, just the decision itself, in which markets are not expecting action, and the press conference, which is always more interesting. If we'll have some kind of cut in the interest rate at 11:45 GMT, I think it'll have huge impact as well, and not only the press conference will have a big impact. Okay, let's talk about the scenarios. First scenario we see is just cutting the interest rate. Now we have up to a year ago or so, we had a corridor of the 75 points between the main lending rate, which stood then at 0.75, and the deposit rate at 0. The main lending rate is the rate that the ECB lends out money to banks, and the deposit rate is the interest rate the ECB pays for banks keeping money with the ECB. So it had the corridor, and it squeezed this corridor of 75 points to just 25 points, 25 basis points. So the main lending rate stands on 0.25 and percent, and the deposit rate is 0. In this first scenario, it makes another cut, which is quite symbolic. It doesn't really matter if the main rate is 0.25 or 0.10 or 0.15. It has a really small effect on the real economy. What it can do is that it will show that the ECB is ready to act, that action is possible and not only words, because the last time we had action from the ECB was back in November, and since then inflation deteriorated and the ECB offered only words. Another advantage is that it will not anger the German Bundesbank. Germany is the biggest country in the Eurozone. It has the biggest impact. Germans are traditionally afraid or lots of angst around inflation. They prefer to have low inflation and low growth than have higher inflation and higher growth. And so this is a small and very cautious step that is certainly within the mandate of the ECB. Another advantage is that it will leave the bigger tools at hand. We'll talk about the bigger tools very soon. So I see the effect of it, that it can have a weaker euro, especially at 11:45 GMT when the ECB announces its decision, but not too long. For the effect to be long-lasting, Draghi will have to to add very explicit threats regarding more action and to convince everybody that more action is on the way, not just this action and that's it. If we don't have big threats from Draghi, I see another opportunity here and gradual buy the dips. I see that this chance has a high probability because the ECB is a bit reluctant to act, especially with the German Bundesbank having big impact. But this is only one scenario. Second scenario is that it doesn't do anything like it did up to now. And Draghi already in the past managed to paint a bright picture out of the not so convincing situation. For example, you could say that the recent bounce in inflation in April in preliminary numbers is significant. As aforementioned, headline inflation rose from 0.5 to 0.7%, and core inflation from 0.7 to 1%. It's still very far from the target of the ECB, but you could say that there's a difference and maybe something related with the banks, and I don't know. The reasons for doing such a thing is, yet again, to keep all the tools at hand. You could still offer words such as more readiness to act, but it could enhance the chance of deflation, because if we have lower inflation for a longer time, there's a lower chance of getting out of the situation and a higher chance of falling down even lower into deflation, which is falling with prices. So there's a big risk here. I think that an outcome of no action at all could be an initial dip in euro dollar again on Draghi's words, like it did last times. But there's a good chance of a swift recovery afterwards. And in the next week, we could see another challenge of 140 and even a big breakout above this level. Because if the ECB once again doesn't act, the words, as I see it, will have only a minimal effect. And after the dust settles down, markets will see that the ECB doesn't have the tools or is unable or doesn't want to, or it doesn't matter. ECB is not going to act, and the euro dollar value can go up. I see a medium probability of this. I think they will do something and not refrain from doing anything. But we'll know that exactly at 11:45 GMT in the initial reaction if there's no move at all. The third option, which I also see medium probability, is the ECB makes a more significant cut. It means cuts the main lending rate from 0.25% to 0.15 or 0.10 and sets a negative deposit rate of 0.10%. That means it punishes the banks for parking money with the ECB. It means if a bank puts €1 at the ECB at the end of the year, he'll have less. So this is supposed to encourage commercial banks to lend out money to businesses and to individuals, and this should, in theory, help the real economy. Another side effect, which is sort of wanted at this point, is to drive money out of the Eurozone because of this negative deposit rate, thus lowering the exchange rate. About 1 year ago, when Draghi's words had more of an impact, each time he mentioned this option of setting a negative deposit rate, the euro plunged. It was significant. This was considered as the nuclear option, especially the biggest impact was just 1 year ago in May 2013. Just answering a question about it in the press conference, sent the euro down. So if he sticks up with his words that there's going to be monetary stimulus if the exchange rate remains high, this is the best tool to use. However, the downside is that it hasn't been used on a large scale. It has been used in Denmark, a neighbor of the Eurozone, part of Europe, part of the European Union. But Denmark is a small country, and we don't know what's going to happen if it's the number 2 currency in the world. So it can have unintended consequences. Maybe too much money is going to flow out, and then bonds of Spain, Italy, Greece, Portugal, Ireland, other countries yields are going to rise. It's going to be euro debt crisis once again. And another bad scenario is that if it doesn't work, it's even worse. It means the ECB used this tool of the negative deposit rate, considered the nuclear tool. The tool is gone and actually doesn't have any impact. The exchange rate remains high. I don't think that will happen. So I think that if the ECB announces a negative deposit, it's a big deal. It's an announcement. It's huge news. I see a big fall in the euro at first, and we'll have a lower value of the euro for some time. It'll take time for this to reverse. I also give this a medium probability. I see a better chance of just a very small symbolic cut, but the ECB said many times that it's technically ready. This tool is certainly within its mandate, and they could always reverse it in the future. So it's possible. And the last scenario that I see something that the ECB talked about many times already in the past is that it announces QE, quantitative easing, means a program to buy bonds in order to push more money into the economy. If the ECB buys bonds, some of them are held by the banks. Banks have more money to lend out to the economy. That's the theory. But how to do it is much more complicated. The United States is one country, a single country. So is the UK, so is Japan. The Eurozone consists of 18 countries. which bonds do you buy? There's European treaty that forbids monetary financing, forbids the European Central Bank to buy bonds. It did buy bonds in the past, and it used other articles in the EU treaty to do that, but it's a very, very dangerous path to walk. There are challenges from the German Constitutional Court, from maybe the European Court of Justice. And which bonds do you buy? You buy German bonds. What effect will it have? Will you buy peripheral bonds? It's moral hazard. Maybe you buy mortgage-based assets, but are there enough to have an impact on the economy? Maybe you do something more crazy, like buy US bonds. As when a Harvard professor suggested, it means this will be a direct forex intervention to buying US treasuries means that the euro dollar will plunge, but you fund the US government from Europe. Weird. Maybe you buy gold. Anyway, and I give this scenario very low probability. There will be probably objection from the German Bundesbank. It's very, very complicated to do. I think they leave it as a really last option. However, just a small anecdote, the ECB did post a job offer. In the position, they're looking for someone for a portfolio manager. Maybe one of you can apply. And it's one of the things in this job offer was an ability to manage bonds, portfolio bonds. So we cannot totally rule that out as well. But so I feel obliged to mention it, but I think it has very low probability. If the ECB does announce QE, euro dollar crashes, and for a long time it will crash deeply. As aforementioned, probability is very low. I don't see it happening, not today and not in the next few months. Here's a summary of the possibilities, scenarios that I've mentioned. First is a rate cut, just cutting the main lending rate without the deposit rate. I give it a high probability, short-term negative impact. The second one, which has a medium probability, is no action at all, continuing what the ECB has done in previous times, just more talk, maybe even stronger talk than before. The talk can have a minimal impact, but the end result, as I see it, is that we'll have a stronger euro. Third option, a negative deposit rate, also has medium probability, I think, and will have a significant negative impact on the value of the euro. And the fourth option is very low probability, quantitative easing. It'll have a huge, huge negative impact on the euro. And all in all, I forgot to mention this before. We did mention the euro dollar is trading in a very narrow range. 140 is the clear cap for euro dollar, political cap, psychological round number, and the 137.80 level is the current support line. It's not as strong as 140, but it's a significant line on the downside. More lines are 136.50 and 135.50 on the before 140. On the top side we have 139.60, and above 140 we have 141.15. Anyway, thanks for those who held on. Last thing I wanted to say was thank you to FX Street for hosting me here. Sorry again for the last minute mess. I didn't really have the opportunity to have a Q&A session, but I hope you did enjoy the presentation. You're welcome to visit forexbrunch.com and contact me through the contact details here, which are my email address, Twitter handle, and thank you very much for the kind words. You're welcome to download the iOS and Android apps. For those of you who stayed along, what do you think the ECB will do? Where do you think the euro will be after Thursday? Do you have any direction? Do you think you're going to trade this event? Possible cut? Yeah, yeah. You think? Do you think that the ECB will also cut the deposit rate and set it in negative territory, or just cut the main lending rate, the main one? Yeah, that's also my scenario. I think markets aren't ready for that, but they are ready for no action, which is the second scenario I presented. I think we'll have some nice action in euro dollar. Yeah, Draghi likes to talk a lot. He did have success in the past with talking, but it hasn't been so successful in the last few weeks with that. Anyway, thank you very much once again. I apologize once again. I'll run my internet provider for a shortcut. Yeah, maybe no action at all. Anyway, thank you very much. Any more questions? Well, I think, as aforementioned, the biggest chance is that we'll see just a cut of the main lending rate without the deposit rate, and that it'll have a short-term negative impact on the euro, but just short-term. And that's my scenario. I think, Mark, if you look at what other analysts are looking at, most of them see no action at all in scenario number 2. And I think it can lead to a much stronger euro. Great. Thank you. Thank you very much. Thanks for you brave people that stayed until the end, even though all the issues. Thank you very much, FX Rate. And I hope to see you next time, hopefully without any technical issues. Thanks everybody for attending and listening, hearing, watching. Good night, yeah, good day for wherever you are in the world. And yeah, midnight in Singapore, early morning in California. Here in Barcelona, it's afternoon. Okay, then I'll say goodbye. Thank you very much once again. See you next time. Bye-bye.